Imagine waking up one morning in 2026 to find that the US Treasury can't roll over its debt. Banks have frozen lending, and the credit system that holds together the world's largest economy has suddenly stopped breathing. It sounds impossible until you look at the numbers. Every major financial collapse in history started with a small crack, a tiny shift, a single domino. Today, those dominoes are already shaking. Surging interest costs, record corporate defaults, and consumers drowning in loans they can't repay. So the real question isn't if the US credit system will reach its breaking point. It's when and why so many analysts believe the year is 2026. For decades, the United States managed to grow on borrowed money, rolling over trillions of dollars at low interest rates, relying on endless foreign demand for its debt, and trusting that the dollar's power would last forever. But now, that system is under extreme pressure. Government interest payments are exploding. Corporations are sitting on mountains of debt that must be refinanced soon, and households are hitting the highest delinquency levels since 2008. In this video, we're going to break down exactly how a modern credit collapse unfolds, why the US faces unprecedented risks in 2026, and how one domino, just one, can trigger a chain reaction that cascades through banks, companies, global markets, and ultimately the everyday lives of millions. Stay with me, because understanding this moment isn't just about economics. It's about preparing for a future that might arrive far sooner than anyone expects. The warning signs no one is talking about, the cracks in the US credit system, are already visible, but most people are too distracted to notice. Corporate bankruptcies have jumped to their highest levels in years, and credit card delinquencies are rising at a speed not seen since the 2008 crisis. Meanwhile, interest payments on US government debt now rival major national expenses, signaling a system under strain. Bond markets are flashing red warnings as yields spike and refinancing becomes more expensive. These early indicators tell a clear story. The foundation of America's credit machine is weakening, and when the world's most debt-dependent economy weakens, everything connected to it is at risk. The first domino: surging government interest costs. For decades, the US government borrowed freely, confident that low interest rates would keep its debt manageable. But 2026 marks a dangerous turning point. As trillions of dollars in government bonds mature, they must be refinanced at much higher interest rates. That means the cost of simply maintaining the debt-paying interest explodes. When interest becomes one of the nation's largest expenses, it squeezes everything else: defense, healthcare, infrastructure. Eventually, the government either cuts spending, raises taxes, or prints more money. None of these options are painless. A surge in interest costs is the first domino that destabilizes the entire credit structure. The second domino: corporate debt implosion. American corporations are drowning in debt accumulated during years of cheap borrowing. But in 2026, more than $1 trillion in corporate bonds come due, forcing companies to refinance in a far more expensive environment. Many zombie companies, which survive only by rolling over debt, won't make it. Defaults, resale, layoffs spread, and investors panic as corporate bonds lose value. This isn't just a business problem, it hits workers, supply chains, and retirement funds. When corporations can't service their debt, the pressure spreads across the entire economy, creating a cascade that accelerates the credit collapse already triggered at the government level. The consumer collapse. After years of rising living costs, American households enter 2026 with record levels of financial stress. Credit card balances are the highest in history. Auto loan defaults are climbing, and student loans have resumed after a long pause. Millions of families are borrowing just to stay afloat, but higher interest rates make even minimum payments painful. When consumers begin defaulting in large numbers, banks face mounting losses and tighten lending standards. This fuels a downward spiral. Less credit means less spending leads to business contraction, and contraction leads to more job losses. A consumer credit crisis becomes a national economic shock. Bank liquidity crisis. Banks rely on a delicate balance of deposits, loans, and investments. But as government and corporate debt values fall, banks begin to suffer massive unrealized losses. At the same time, rising defaults drained their capital reserves. To survive, banks pulled back on lending, triggering a liquidity freeze. Small and mid-sized regional banks already weakened become especially vulnerable. Some may fail outright. When depositors panic, the crisis accelerates. A banking system that was once flush with cheap money suddenly becomes paralyzed. And in a credit-driven economy like the United States, when banks stop lending, the entire engine of economic activity grinds to a halt. The global domino effect, the U.S. credit system, isn't just domestic, it's the backbone of global finance. When the U.S. struggles, the world feels it. A 2026 credit collapse would push foreign nations to reassess their exposure to U.S. debt. Some may begin reducing their treasury holdings, weakening demand for the dollar. Emerging markets dependent on U.S. credit lines could face immediate crises. Global trade, which relies on dollar-based financing, slows sharply. Major economies like China and Europe would feel the shock through exports, banking stress, and market volatility. The collapse of U.S. credit confidence becomes a worldwide financial contagion that spreads far beyond American borders. How the government will respond when a credit collapse hits. The government cannot sit still. Policymakers may attempt emergency measures, bailouts, stimulus checks, liquidity injections, and programs to support banks. The Federal Reserve could intervene by slashing rates or implementing yield curve control, essentially forcing borrowing costs down. But each solution carries consequences. Massive intervention may stabilize markets temporarily, but risks creating inflation or weakening the dollar. In the most severe scenario, the government might accelerate the introduction of a central bank digital currency to regain control over the financial system. These responses may slow the crisis, but they cannot prevent the structural reset already underway. The last domino. System reset. Every credit collapse in history ends the same way, with a reset. In 2026, the U.S. may face a moment where the old system of endless borrowing can no longer function. A reset could involve restructuring government debt, shifting global reserve currency dynamics, or creating new financial rules for banks and corporations. For citizens, it may mean stricter lending standards, new forms of money, or a redefined role for the Federal Reserve. While resets are painful, they also create the foundation for the next economic era. The question is not whether change is coming, it's how prepared people are when it arrives. As we've seen, a credit collapse doesn't arrive with a single dramatic moment. It builds slowly, one domino at a time, until the entire structure can no longer hold its own weight. The warning signs are already here. Rising defaults, surging interest costs, fragile banks, and a global economy tightly tied to America's financial heartbeat. If 2026 becomes the breaking point, it won't just reshape markets, it will reshape the lives, decisions, and futures of millions of people. But understanding these signals is the first step toward protecting yourself. Stay alert, stay informed, and never assume the system is too big to fail. Because history shows that every empire, every currency, and every financial structure eventually meets its moment of truth. If you found value in this breakdown and want deeper insights into money, crises, and global economics, make sure to subscribe to the channel. The next video might be the one that helps you see the next domino before it falls.